Welcome to the Hurley Investments presentation of how to sell stock short with options. Simple concept in all honesty. It's the same principle as shorting a stock outright, but you're going to apply options to do the same thing. As you would if you're going to short a stock, you find shares of the stock that you think will go down. You typically want a reason, a technical reason, a fundamental reason, poor earnings, company going out of business, change of a CEO. You're looking for an event that's going to cause a prolonged or a continued possible bearish or downward movement. You always like to verify it with the chart. Once you found that stock, instead of selling it outright, having to contact your broker, you sell to open the short call. You sell to open this option position. It creates a credit into your account. You now have the obligation to sell your stock at a certain price for a certain period of time. You're going to have margin withheld out of your account to honor the obligation. The advantage of doing it with an option is you might only have 40%. It doesn't have to be 100% cash covered like shorting a stock does. The key here is you have unlimited risk, like shorting the stock outright. I'm going to explain that to you in a minute. And typically when you want to use an option, you're looking for as short as time frame as possible. 30 days or less is the general rule. You want this trend to stay intact until this position either expires worthless, so you get to keep that credit that you sold it for, or so you can close it down, buy it back for a profit. When some people hear me say buy it back, it's like selling a car for $1,000 and buying it back for $200. You sold it for $1,000, buy it back for $200. You're going to make $800 on that transaction. But the key is short periods of time, 30 days or less, and have that option expire worthless so you get to keep that credit. Now, the key to this position is it has unlimited risk. So you need to find a way to protect this position. Typically, this option is called a short call or a naked call. A naked call means you're outright using the option to short the stock, and you need to be aware of trend changes. You can't have it reverse. I have an example here that directly relates to the company Baidu. Baidu is trading 100, 160, I don't remember exactly, but for our example, is trading at $100, and Google ended up getting kicked out of China. Well, over the weekend, the stock shot up like $180. In this scenario, if you're going to be obligated to sell a stock at 100, that was going to go down to 80, so I could buy it back at 80 and make the difference between 80 and 100, 20 bucks. In this example, Monday morning, your stock opens up at 200, you're kind of in deep trouble. You're now buying stock at 200, or in this example, $260 a share, to turn around and have to sell it for 100. This has unlimited risk because who knows how high a stock can go. A stock could go to an unlimited $1,000, $1 million, where if you're shorting it, you're obligated to turn around and sell it to someone back to 100. So for this reason, you got to be careful. You literally, as I say before, expect to close that position, short it, put a stop loss on it, so that way if it turns, you could be protected during the day, but you do hold some pretty high risk overnight or through a weekend. If you have any questions, I hope you give us a call, 888-287-1030. You're always welcome to go and find us on hurleyinvestments.com, or you could go to myhurleyinvestment.com. Email us at support@hurleyinvestments.com. We look forward to presenting more of these short videos for you. Look to see you again soon. Come check our website, like us on Facebook, like us on Instagram, and you'll get announcements every time we get these out to you.